What if the oil price you see on TV is not the oil price shaping your life? America became one of the world's largest oil producers. Oil prices collapsed in 2014, again in 20, and fell sharply in later cycles too. But gasoline prices often stayed painful. Inflation stayed sticky. Airline tickets stayed expensive. Shipping costs surged. Grocery prices climbed. So what broke? The answer is simple. There is no longer one oil market. There are now multiple oil realities competing against each other, and most people only see the headline number. When people hear oil prices, they usually think there is one global price for oil. But there are actually different benchmarks controlling different parts of the world. The two biggest are WTI and Brent. WTI stands for West Texas Intermediate. Brent comes from the North Sea. And the difference between them quietly shapes inflation, gasoline prices, corporate profits, and even politics. Most Americans hear WTI quoted on financial television, but much of the global economy reacts more closely to Brent. In fact, since 2011, U.S. gasoline prices have often tracked Brent more closely than WTI. That matters because Brent and WTI stopped moving together the way they once did. And when that relationship broke, the modern energy system changed with it. For decades, WTI was considered the premium crude benchmark. It was lighter, sweeter, easier to refine, and tied to America's industrial power. Historically, WTI often traded above Brent. But then came the shale revolution. America suddenly produced enormous amounts of oil from Texas and other shale regions. Production exploded, but the infrastructure could not keep up. Pipelines became congested, storage hubs became overloaded, and the center of the WTI system, Cushing, Oklahoma, became a bottleneck. WTI was trapped inland. Meanwhile, Brent remained globally connected through ocean shipping routes. That changed everything. This is the hidden plumbing most people never see. WTI is heavily tied to inland American logistics. Brent is tied to the global seaborne market. That means Brent often reacts more directly to wars, shipping disruptions, sanctions, and global refinery demand. WTI can become temporarily disconnected from those realities. So even if American oil production surges, consumers may not feel relief because gasoline pricing is still linked to global energy dynamics. That is why energy independence did not create price independence. And then something even bigger happened. Oil stopped being just an energy market. It became a financial market. Today, oil prices are influenced not only by physical supply and demand, but also by hedge funds, commodity ETFs, options traders, algorithmic systems, and passive investment flows. Oil futures became macro assets. Large financial players can influence oil volatility without ever touching a physical barrel. That is a massive structural shift. Because once oil becomes financialized, prices can move based on positioning instead of immediate physical shortages. Oil is still anchored by physical barrels, but the day-to-day price is also shaped by expectations, positioning, and liquidity. This creates conflicts across the entire economy. Oil producers often want higher global prices. Refiners sometimes benefit from discounted domestic crude. Governments want lower inflation numbers. Central banks want stable expectations. Consumers want cheaper gasoline. Investors want profitable energy companies. These incentives do not align. In fact, many directly conflict with each other. A producer may celebrate rising oil prices at the exact moment consumers feel financial pain. An energy stock rally can happen while households struggle with inflation. That is one of the deepest contradictions inside the modern economy. And this is where the Brent WTI spread becomes more than just a trading number. The spread can quietly signal stress inside the global system. A widening spread may reflect pipeline bottlenecks, export demand, geopolitical fragmentation, refinery shortages, or shipping disruptions. Sometimes it signals that global energy markets are becoming less connected. Other times, financial positioning can amplify moves that started in the physical market. The spread becomes a kind of pressure gauge for the world economy. The clearest example came in 2020. During the pandemic, oil demand collapsed. Storage tanks filled rapidly. And then something historic happened. WTI futures went negative. Negative oil. Traders were literally paying people to take contracts off their hands. But this was not because oil suddenly had no value. It happened because the financial structure of the market collided with physical delivery constraints. Too many paper contracts, not enough storage. That moment exposed the hidden fragility inside the benchmark system. Then came another major shift. Russia's invasion of Ukraine. Suddenly, Brent surged as global markets priced geopolitical risk. Shipping routes mattered more, sanctions mattered more, refinery access mattered more. Again, consumers discovered something uncomfortable. Even if domestic production is strong, gasoline prices can still rise sharply because the global benchmark system still dominates pricing behavior. The public thought national production would shield them. The market said otherwise. And now we arrive at the biggest contradiction of all. Many people believe lower oil prices should automatically reduce inflation, but that relationship has weakened. Why? Because crude oil is only one layer of the pricing chain. Refining margins matter. Transportation costs matter. Corporate pricing behavior matters. Global shipping routes matter. Financial hedging matters. And in some sectors, prices can stay sticky because contracts, margins, and consumer expectations adjust slowly. That is why oil can fall while daily life still feels expensive. This is also why politicians often focus on gasoline prices instead of benchmark oil prices. Consumers do not emotionally react to WTI. They react to the number on the gas station sign. And governments understand that. That is why strategic petroleum reserve releases are often political events as much as economic ones. They are attempts to influence inflation expectations and public psychology, not just physical supply. And there is one more structural reality emerging beneath all of this. The world may be entering an era where oil benchmarks themselves become geopolitical battlegrounds. China has been building yuan-denominated energy contracts, but they remain far from replacing Brent or WTI globally. Middle Eastern producers are diversifying partnerships. America became a major exporter. Global trade routes are fragmenting, and energy markets are becoming more regionalized. If that trend accelerates, the benchmark system itself could splinter. That would reshape inflation, currencies, trade flows, and global financial power. Because benchmarks are not neutral, benchmarks influence who absorbs volatility and who captures profits. The biggest lesson from all of this is simple. The oil market most people imagine no longer exists. There is no single oil reality anymore. There are overlapping systems: physical, financial, geopolitical, and political. And the benchmark itself became part of the inflation system. So the next time you hear oil prices are falling, ask a different question. Which oil price? Because in the modern economy, the benchmark matters almost as much as the barrel itself. And whoever influences the benchmark quietly influences inflation, profits, politics, and the public's cost of living. This is Global Notes by JP. If you found this helpful, comment, like, share, and hit the bell. We're building the strongest macro community on the platform, one signal at a time, together.